Yeah.
Are there any specific requirements, Mark, that investor owners should be aware of in terms of documents or other requirements to qualify for funding?
Well, like I said, they're more lenient because if you look at it this way, and I'm reading between the lines with this is my own personal opinion. The center lane of underwriting. Let's take Fannie Mae and Freddie Mac for example, which is kind of the plain vanilla, standard underwriting metric for the the mortgage industry. um, they'll want you to have all the standard documentation, but that doesn't mean that that's the only way to get a loan. So some of these non-traditional programs are really, really helpful in, in trying to get that type of financing that you might not otherwise be able to get. So if you're going down the center lane of underwriting, they're going to ask you for the same documents you'd be asked for if you were buying a primary residence: tax returns, bank statements, pay stubs, W-2s, documentation on your other properties if you own any. If your property's in an LLC, they'll want to see the LLC formation documents. If it's in a trust, they'll want to see the trust agreement, things like that. Credit report is standard for any mortgage you're trying to apply for. But what's different about the non-traditional financing is it usually is with the intent of taking out the income side of qualifying. So if you're doing a DSCR loan, for example, you're not going to be asked to provide tax returns. In fact, if you send them to your lender, they will probably slap you on the wrist and say, "Don't send this to me." They don't want to see it because it's not the basis for the approval. So the documentation for these non-traditional loans usually are designed to eliminate the challenges that most people have with qualifying for loans, which is the income side. Obviously, the down payment, for an investor is typically going to be the required down payment a little bit higher than what it would be if you were buying a primary residence. So if you could do, for example, an FHA loan with 3.5% down or a Fannie Mae loan with 5% down as a primary residence, you might need 20% down, sometimes even 25% down, depending on the program for an investment property. Now, there are programs that may allow you to finance more than 80%, but that's when you're going to start paying a premium in the interest rate and it's going to squeeze your cash flow. So my personal advice, whenever possible, put at least 20 to 25% down in investment property to give yourself good cash flow, a little bit of wiggle room. So if the property value changes a little bit over time, you're not in a tight position. That's always good to kind of protect yourself. But as far as documentation, it really varies depending on the type of loan that you're getting.
Terrific.